Hello, everybody. Good morning to you. Hope your day is going very well. An interesting topic I hope to tackle today. If I tell you the day, August 14th of 2019, what comes into your head? Rosie, probably I was on vacation or enjoying life with a barbecue. It was a midweek day, a Wednesday. Probably nice, beautiful weather around much of the northern hemisphere, but it certainly marked a titanic day. When we look in events recently in the markets and particularly the current collapse that has occurred, a little bit of technical background. There's very few. I've been a student of markets since 1979, 1980, especially a very close study of financial markets through periods of, well, when they first started forming trading companies in Britain centuries ago. And I found it very fascinating just to intertwine the way that human nature behaves in the face of financial and economic crises. It's very interesting to me. And I look for things that are never fail when it comes to investing doctrines. And on that day of August 14th, 2019, a bell was rung that signaled that something was seriously amiss within the United States economy and that smart people should contemplate taking action at that point in time, which I did. Now, what happened on that day, August 14th? Coronavirus was nowhere to be seen. There were no United States Senate intelligent briefings on coronavirus that caused some senators to sell with the news. That was in January of 2020. We're talking about August, some 4 months before, on a sleepy mid-autumn dog day of summer. Something happened that told the truth about what was going to come, as opposed to what people believe has been the cause of our current economic calamity. You need to bear one thing in mind here, is that when it comes to market bubbles, which we've been in for many years because, well, let's face it, frankly, the Federal Reserve forced us into a situation where we had very few alternatives to pursue in terms of capital growth. They made investing in savings account holdings virtually useless. There was really low yields, interest rates on bonds, notes. They wanted that money to go to one place, all that liquidity to go to the stock market so that investment might take place and to push economic growth. Things haven't been too good under the surface for quite a few years. You had some what I call phony baloney of stock buybacks and things that sort of meant that the pie was being cut into fewer pieces so it looked bigger. But there were problems with earnings and revenue growth. It was getting a bit harder out there. Okay, the reality is on August 14th, 2019, something big happened. On that day, the yield or return on a 10-year loan to the US government paid you less interest than lending money for 2 years. Interest rate on the 10-year, the return you got became less than what you got if you lent the government for 2 years. Is this a rare thing? Oh boy, is it rare. When you think about things logically in your mind, it should be rare. If I come to you and say, hey, John, I need to borrow money for 6 months. I need $1,000. I'll pay you a little interest on it. Yeah, that is fine. Just give me 5%. Just pay me back $1,050 in 6 months and it's all good. Man, that's great. Suppose I come to John and say, John, I want to borrow money for 10 years, $1,000. Now, John's thinking in his mind, lending money to somebody for 10 years is a little riskier, okay? Rosie could die. right? The world might come to an end. We might have a virus pandemic. I'm going to need a little more than 5%. I'm going to need about 10%. I think will be good. That I believe will rightfully compensate me for the risk I'm taking. Well, you may not be around. You may flee the country. Okay? And I might not get my $1,000 back. That's okay. All right. I'll pay you $100 a year interest. Yeah. Okay, lend me the money. That's a normal lending relationship. That is a normal lending relationship where the longer you lend, the higher return you expect because the risk is higher. But suppose you went to John and said, John, I need to borrow $1,000. And John said to you, well, I'm going to charge you $100 for, I'm going to charge you $100. You pay me $50. Pay me back $50, $1,050 in 6 months. And I said, well, how about if I borrowed for 10 years? And he said, well, just pay me back my $1,000. You'd be like, wow, I'm free riding. I'm paying you more to just return your money in 30 days than I'm not paying anything if I hold it for 10 years. Yeehaw. You can see how unusual a relationship that is. When that happens in bond markets, and particularly the United States bond market, it's a signal of real trouble ahead. Something is driving long-term rates lower, and that tends to usually be a recession where people flee to what's perceived to be a high-quality asset, such as the United States note or bond, a long-term one. So rates get driven down in expectation of that, and usually it presages fearful times. Has it been perfect? Yeah. It's been perfect for as far back as they're looking like 1970, okay? It's had a perfect record. Every time that the yield on the 10-year has gone below, the two lines have crossed the 2-year, we've had a recession. Now you say to yourself, Rody, August 14th, 2019, hey, we went up for months after that. September, October, November, December, January. We went up almost another 5 months. Yes. Yes, the bell signal has been forgotten. The momentum of the stock market carried on. But the economic statistics that were coming out were beginning to deteriorate underneath. Industrial production, trade figures, slowdowns, factory slowdowns. The warnings were there. So what was the coronavirus? But that was the pin that popped the balloon. But it was baked in the cake by the signal of August 14th of 2019, because every time this has happened, we have had a recession, and sometimes they have been severe, but it does not stop traffic immediately when the bell rings. Some people poo-poo it. Some you'll see below with the link in the description box down below, that they'll write all kinds of stories that, hey, don't worry about it. It doesn't matter this time. It always matters. When you want to look at the roots of the real signal that I told you months before, there were Senate intelligence hearings in January 2020 that gave cause for several senators to go out and dump their stock. That was months in the future. Hell, the whole coronavirus thing in China was months in the future. There was something going on long before that day, and the bell was tolling on August 14th of 2019. How many of us heeded that warning and began to get our ducks in a row to move out of the way? Simple canon of investment. Yeah, sometimes the most useful things are the most simple things, but let it be known forever that the day you should really focus on in the beginning of all of this current calamity, crash, and panic is August 14th of 2019. Anyway, I hope you enjoyed this historical look at things. I do have as the thumbnail the charts that show the gray areas where recessions have followed every time that we have pulled negative and had a yield curve inversion. It's a pretty good record. Definitely worth listening to. And click the link down below to hear how some pundits started to work hard to immediately dismiss the signal of impending trouble. Thumbs up are appreciated. I look forward to your comments below, and have a wonderful, wonderful day.